I think the cycle could, go on for longer than people expect because it's not driven by the halving. It's driven by broader macro and interest in the asset itself. My guess is up. I don't have a view of the next quarter. I always do try to avoid price predictions when I get quartered into one. Like for 2025, I was like, yeah, anything under like if we don't hit 150, it'd be a little disappointing. Of course, we only got to like 125 or so it's on the disappointing end. I do expect that, in 2026 we'll be back into the six figures. I mean, anything can happen between now and year end. And whether it's 2026 or 2027, I think we'll be seeing new all-time highs most likely.
When market noise grows louder and predictions fall apart, the smartest investors shift their focus to the structural forces quietly shaping Bitcoin's next major move. In reviewing Lyn Alden's latest analysis on Bitcoin, you get the sense that she sees the asset entering a more mature and structurally driven phase, one that mirrors the long, steady ascent of the MAG7 tech giants. Her comparison is striking. Just as Apple, Microsoft, and Nvidia defied years of "it's overvalued" criticism while quietly compounding, Alden believes Bitcoin may follow a similar trajectory. She argues that despite skepticism around its $2 trillion market cap, Bitcoin's growth is shifting from explosive speculation to slower, more durable adoption. From your perspective, her dismissal of the traditional halving cycle as a dominant driver seems increasingly logical. As she points out, liquidity conditions and broader macro forces now overshadow halving dates in shaping market direction. What stands out is her confidence that Bitcoin will reclaim six figures in 2026 and likely reach new all-time highs between 2026 and 2027, driven largely by institutional participation rather than retail hype. Tom Lee's stance, which you interpret as cautiously optimistic, complements Alden's framework. Even after acknowledging that his $150,000 target for 2025 may fall short, his bearish bull tone suggests conviction in Bitcoin's longer-term direction. With 2 months left in the year, you see his view hinging on improvements in macro liquidity, an environment that could still allow Bitcoin to surprise investors to the upside as 2026 approaches. If this analysis reshaped how you view Bitcoin's next chapter, drop your thoughts in the comments, share it with fellow investors, and don't forget to subscribe for deeper market insights.
While you can't do the thing you'll see on Twitter where you overlay the global liquidity chart, the Bitcoin chart, and try to make like 3-month projections about Bitcoin, there still is a general causal and interesting correlation there over a longer time frame, and that it generally gives you a pretty good insight into direction. Of course, the other variables is that because Bitcoin is this new and emerging asset, and compared to other assets, even though it's been around for a while, it's still new and small. That it's subject to idiosyncratic things. And so, for example, the election in November of last year, almost exactly a year ago, that gave a really big boost because it kind of changes the forward estimates for what's going to happen with regulation, what's going to happen with different things like that, and that has nothing to do with liquidity when something like that happens. And same thing with the ETF launch, same thing with some of the accounting changes for Bitcoin treasury companies. These are things that have nothing to do with macro or liquidity that can really shift the asset around. But then, of course, I think liquidity is a really big variable, and I think that Bitcoin is more correlated with liquidity than most other assets. I think it's actually the more interesting factor is why it's been flat for so long, because the crash itself, like even in the 2017 bull run, that was a fairly smooth and kind of parabolic bull run, but it still had multiple sharp 30% corrections along the way, like several.
Yeah.
And it would just have these V corrections and shoot back up. So it's not necessarily that this one's had really big magnitude. I mean, we touched like 75K back in April, for example. It's not really the size of the corrections. It's more of the length of time of lasting in the state. So the fact that we were 100K in November of last year, and we're, after a year, we're basically flat, and now we're down to some extent. That's, I think, the more noteworthy item. So I don't really view Bitcoin as crashing. I view it as basically stagnating at this time. I think that's the more noteworthy event. There's a lot of factors that can go into that. I think that liquidity is a factor. So we do have tighter liquidity now. But when you look at kind of broader measures of liquidity, they're really not that bad, and I don't expect them to get that bad. I think we're kind of in the bottoming phase for domestic base liquidity at the current time, and broader liquidity is mostly fine. So I think that liquidity is doing it no favors this particular month. I think there's a broader issue. It's AI potentially sucking some kind of capital enthusiasm away from Bitcoin. It's kind of the fastest horse narrative. Obviously, gold has had a really good year. And then there's also, to some extent, the disillusionment with the other catalysts for Bitcoin. And so, for example, one of the most popular questions I got on Bitcoin podcasts in early this year was, "What do you think about a sovereign Bitcoin reserve?" And I found that the most boring question. I mean, people had to ask it, but I found it, and I even said it a couple times that it was like the most boring question because one, as far as kind of the ethos of Bitcoin, I find the decentralized aspects way more interesting than what is the nation state going to do with it. And two, I'd said I'd rather kind of have a price estimate that doesn't include, Uncle Sam buying 500,000 coins. I'd rather be surprised at the upside if that does happen than to factor that all in and then be surprised when it doesn't. Because my view at the time was that sure, they're going to ring fence the coins they already have, that they don't owe back to someone else. But that any accumulation from there, I think would probably be marginal at best. And I'd be happy to be proven wrong, but that was kind of my base case, and I would just plan for that. I think a decent chunk of Bitcoiners were kind of really bullish on that outcome, really bullish on a lot of things. And then when those expectations don't really align, even though it's otherwise a pretty good environment for Bitcoin, especially looking over 2, 3 years rather than just the 12-month period, you start to get deflated expectations. And then lastly, because it's had this pretty small sample size of this 4-year cycle behavior. So it peaked in quarter four 2021, it peaked in quarter four 2017. There are a lot of people saying, well, it's probably going to peak here in quarter four of 2025, and therefore they sell it preemptively and kind of create a self-fulfilling prophecy. I think that the halving cycles no longer are particularly relevant. I don't think even last cycle they were particularly relevant. I think they happen to correlate with the liquidity cycle. I think they certainly were relevant. The first, say, three halvings periods, I think were pretty relevant. I think they've diminished to the point where it's no longer a factor I particularly concern myself with at all. It's more about those other factors. And so I think there's a bunch of disillusionment that's being kind of washed out. Um, and you can have an asset that is a good asset that's sometimes held for the wrong reasons. And so I think the coins are kind of rotating away from people that held for the wrong reasons or the wrong expectations, and back toward the hands of those that have I think more conservative expectations, while still, of course, being bullish, which is why they hold it in the first place.
When conviction turns into entitlement, markets have a brutal way of reminding investors what reality actually looks like, especially in Bitcoin. Lyn Alden's perspective on Bitcoin resonates strongly when you consider how many investors approach the asset with expectations shaped by past cycles rather than present realities. From your point of view, her emphasis on emotional misalignment is one of the most important takeaways. She argues that the real problem isn't Bitcoin itself, it's that many holders still expect a $2 trillion asset to behave like a small-cap rocket ship. You agree with her assessment that this mindset leads to dramatic sentiment swings, where social media oscillates between euphoric moon calls and declaring Bitcoin a Ponzi the moment a correction hits. In your analysis, Alden's point that no one is owed a bull market is a necessary reminder in a space dominated by hype. Her remarks on gold reinforce the broader theme of mispriced expectations. Even she, a long-term gold bull, didn't anticipate the rapid run to $4,000, underscoring how structural forces, sovereign accumulation, fiscal dominance, and geopolitical risk can reshape markets faster than models predict. When you apply this lens to Bitcoin, Alden's view that capital is rotating toward assets perceived as low risk makes sense, especially in a stagnant macro environment. From your perspective, her caution is timely. Optimism is already priced in, and Bitcoin's valuation assumes widespread future adoption. Investors, you believe, would be wise to approach the next phase with measured expectations rather than explosive assumptions. Let's get back to the interview.
Too heavily in Bitcoin in the sense that their expectations don't match reality. So what too heavy in Bitcoin means can of course vary depending on the person, but it's either having too much exposure compared to your volatility tolerance,
Yeah.
or holding it because you expect a 10x gain in a very short period of time, even though it's a $2 trillion asset. Um, as though it's a prior cycle, and they're rather than holding it as something that maybe you expect to outperform significantly, but not in that explosive time. I think that people kind of get into a mindset where they're owed a bull market,
Hmm.
which no one's owed a bull market. But then, I mean, the emotional kind of roller coaster is pretty palpable. If you watch Twitter, back when, whenever like MicroStrategy is at 3 times MNAV, the whole Twitter feed turns into like, well, I could actually go to 5 times MNAV. It could go to 10 times MNAV. We're going to the moon now, guys. And then as soon as everything rolls over, it's like, oh, the cycle's dead. That's a Ponzi. This whole thing. It's just like the roller coaster is pretty palpable. If you're just like watching it regularly, it's kind of like a cartoon almost. How these kind of roller coasters come and go. It's usually not as good as people expect, and it's usually not as bad as people expect, is often how these things play out. Well, it's funny because I've been a gold bull, but I'm surprised as well that it hit 4,000 this year. When it was in when it still had a 2,000 handle on it, I was kind of eventually looking forward to the 3,000. But I didn't think you'd kind of just race right to 4,000. So I'm happy it did, but wouldn't put it as my base case, especially given the size of the market. It's a huge kind of multi-trillion-dollar market cap increase in it. Um, there's multiple shifts happening. One is ever since 2009, you've had a gradual shift towards sovereign reaccumulation of gold. So prior to then, you had a multi-decade kind of divestment of gold among sovereigns and toward treasuries. Starting in 2009, that gradually reversed. It got kicked into overdrive in 2022 because then you have potential risk of confiscation or freezing of assets if a sovereign is holding their and securities of another nation. They're not really sovereign assets. And so there's kind of been a shift toward that. Then there's the increasing awareness of fiscal dominance and the increasing awareness that nothing stops this train, which says, well, if this is just going to happen for 5, 10, 15 years, maybe I want to own some gold. That's the one that's got an established track record. So big pools of capital already know what to do with it. They don't have to research it. They already know what gold is. Um, and then in addition, this is not really, even though the stock market is near all-time high, it's because it's so narrow, it's mostly not even a risk-on environment. Like I mentioned before, we've been in an unusually long period of kind of like flat yield curve, PMIs, like purchasing managers indices of like manufacturing and other signs that are just kind of like in stagnation. Um, Outside of AI, the stock market is pretty flattish, kind of consolidating. And so it's not a very risk-on environment, even though liquidity is good. So when you have kind of pretty decent liquidity up until maybe very recently, and then you have kind of stagnating broader economy, the Fed still trying to tighten things where it can. The things that have taken off has been AI, gold, like kind of what the market ironically looks as low risk. They view AI as low risk, even though the pockets of it that are obviously not, but they view it as low risk because they view it as like a sure thing. It's like,
Hmm.
okay, that's cycle resistant. Let's go to AI. Then they say gold, okay, that's low risk. Bitcoin, until pretty recently, was in that bucket, where it's benefiting from liquidity, from kind of gradual adoption. But as you have kind of like a flattish environment, Bitcoin cooled off.
Looking at Bitcoin's current dynamics, you can see that the market is shifting towards structural maturity rather than short-term speculation. From your perspective, the recent stagnation reflects a broader recalibration where macro liquidity, institutional flows, and adoption trends carry more weight than historical cycles or hype-driven expectations. Investors overestimating near-term gains or assuming automatic bull markets are likely to encounter emotional swings, while those with measured expectations may benefit from the steadier accumulation of value. Technical indicators, including the 18% bullish market sentiment and a fear and greed index reading of 14, suggest extreme caution is still warranted despite optimism priced in. With Bitcoin showing 50% green days over the last month and price volatility at 4.85%, you can interpret this as a market in consolidation, preparing for potential upside toward the $98,400 range by November 20, 2025, driven more by structural factors than speculative enthusiasm. Do you think Bitcoin's next major move will be driven more by institutional adoption or macroeconomic trends? If this analysis reshaped how you see Bitcoin's path forward, Share your thoughts in the comments, spread it with fellow investors, and subscribe for more in-depth market insights.